All right, well, we will go ahead and get started, and then as other people come in, we'll just go ahead and bring them in at that point. I want to be respectful of your time, so we will go ahead and get started. Thanks for joining us. We are going to be going over two GASBs that are coming into play this year and potentially next year, depending on how you decide to implement. My name is Sheridan Jurgensen. I know there's some of you I have not met before. I'm one of the partners that oversees the government side, and then I'll have Kevin can introduce himself for those of you who haven't met him. Just a couple things. I have muted everybody, so if you have any question, you can go ahead and mute or unmute yourself. We are going to ask though that if you do have questions throughout, if you can put it in the chat, and then we're going to try and get through all the slides first, and then open it up for questions after we go through GASB's 87. So any questions, just go ahead and put those in the chat, and we will address those at that point. And I also, there should be a file section that you can see. It might be under the more section.
There's also file.
Yeah. Oh, it's in the chat. I'm sorry.
Yep.
So on there's the PDF of the presentation as well as the Excel spreadsheet that we're going to go over that will be related to the standard. So I think that's all for that. So I'll let Kevin get started.
Okay. Like Sheridan said, for those of you that don't know me, I'm Kevin Smith. I am the other partner in charge of the governmental audits. So, we're going to try and split this up as best as we can so you guys don't have to listen to one of us talk the whole time. So I'm going to start off. I'm going to share the PowerPoint here. See that now? Showing up there good. Okay. Okay. So the exciting topic of the day is going to be the new lease standard. Initially, we're going to start off with 87. We're also going to be going over 96 as well. That's the subscription-based leases, so all your cloud computing type stuff. Going over them all together, just due to the fact that some, I guess not some, but the AICPA is recommending that you consider implementing these both at the same time. 96 isn't applicable right away this year. They're saying to consider it just because you're going to go through a bunch of contracts at once as opposed to having to go through it twice. So just to start off here, like I mentioned, GASB 87, I'm sure you guys are all aware, is going to be applicable for this year end. It's going to impact basically every government and is essentially most leases that have some sort of asset component to them now, or a tangible asset, are going to be recorded as an asset and a liability. So things we'll go over that are changing. There's going to be some new definitions of a lease, and then also define some of those lease terms as well. So the main provisions, leases are basically some sort of financing for the right to use an underlying asset. What you're going to see in here now is what you guys are used to is some of the old terminology, the operating lease and capital lease terminology. That's basically gone now. It doesn't exist. They've basically redefined different things now. So as we'll get into the definitions, you'll see that those terms really don't apply anymore. There are some exceptions for short-term leases. And also, obviously, as we've discussed with some of these things in the past when we were out for audits with you guys, if some of these things are immaterial, they're just not going to apply. If we come out and all you guys have are copier leases, obviously we're not going to do all this for a few copier leases for a few $1,000 a month type thing. So, the implementation dates. So this is going to be a few slides that just kind of go over like how these apply and how to look at these things as far as whether the current period, comparative period, and how things are going to be restated. So as far as the implementation dates, it's applicable for your June 30th, 2022 year. It is effective for that fiscal year, but with the way you have to look at it is it's basically the facts and circumstances, everything that was in place as of July 1, 2021. So when you're looking at this for this year, you're going to look at leases that were in play as of July 1st, 2021. If you're reporting to periods where you have comparative financial statements, then you have to go back a year further. Sorry about that. You have to go back a year further then and actually go back to July 1, 2020, because since you are presenting the prior period and this standard's applicable, you have to show the leases for that period as well too. So we'll get into a little later, but we are recommending, at least for this year, in order to save costs, that if you do present comparative financial statements, that you consider doing single financial statements for this year. So again, this is another slide, basically just doubling down on that, where we're clearly showing the effective date is the July 1st, 2021 date. So as you guys are looking at leases, you're going to look at the leases that were in place as of July 1st, 2021. And I keep saying in place as opposed to started, because as we'll go over later too, is if you have a 20-year lease and you're in year 5 of that right now, as of July 1st, 2021, you had a lease, so you measure it as of what's left as of that point. So again, this is just another slide just kind of giving you a visual example of if you are presenting comparative financial statements, you are going to have to go back to July 1st, 2020 and look at for all leases that were in place as of July 1st, 2020. So, you know, like I mentioned before, we are recommending that if you do comparative financial statements, that you do single year presentation for this year. So then the implementation period. So again, this is just going over a couple notes as far as the leases should be recognized and measured using the facts and circumstances that existed at the beginning of the implementation period. So the 7/1/2021 date. The changes need to be adopted retroactively by restating the financial statements. Basically what that's saying is, you know, like any other GASB that we've implemented, a lot of the ones, you know, for example, GASB 84, when it got implemented, you guys had a prior period adjustment where you had a net position adjustment. It's going to be the same thing. You're going to look at what would have been on the books as of the beginning of the year and get that onto the books. And how you're going to do that is through a net asset adjustment for the financial statements and the government-wide financial statements. Again, this is only going on government-wide as far as this adjustment. So it will be a net asset adjustment or a net position adjustment. And then this is just some notes for, I mean, this is going to affect us more than you guys, but if a restatement is not practicable, the cumulative effect should be reported as a restatement at the beginning of that position. I mean, that's the adjustment that's going to be made. So that's going to be more on our guys' end. What you guys are mostly going to be concerned with is basically letting us know what leases are out there, so that would need to be adjusted accordingly. Again, we're going to do some testing related to this as well. Kind of similar to like we do a search for unrecorded payables type thing. We'll do a similar search for leases too. I mean, you guys will provide us with what you think the leases are. We'll do a similar search, and then if we find something that maybe is not on there, we'll, you know, discuss with you guys, hey, you know, is this really a lease that could fall under this type of thing? So next, I will hand it off to Sheridan to give you guys some updated definitions.
Okay, so if you want to go to the next slide. So as we kind of mentioned, in the past, we've been just dealing with operating leases, capital leases. So you just have to kind of ignore all those past definitions and how we qualified them between the two. And this is now going to be the new definition of leases. So really, it's a contract that's in place that allows you control with the right to use that asset. And it's specified in the contract for a period of time, and it's going to be an exchange transaction. And so in order for you to have control, you have to be able to have obtained the capacity to use the asset, as well as you have to be able to determine how you're going to use that asset. And so those are kind of the two criterias when you're looking at what control really is. It's also important to note this does not include contracts for services. So if you have maintenance type agreements that do not involve any assets per se, then that is not going to be included in here. It would only be an issue if, let's say, you have a significant copier lease of some sort, hundreds of copiers, and there's a maintenance portion of that lease, but you're also getting the copiers. Then we're going to have to look at that lease because it includes both. But if it's strictly just for services, that will not be included. It's also important to note that for control, it doesn't have to include every day of the week. So if for some reason your lease, you are renting space only 3 days a week, as long as you have control of that space for those 3 days a week, as it specifies in the lease, then it will qualify. So it's not so much you have full control for the entire period. It's just whatever is stated in the agreement as far as the days of the week or the time frame that you can use that. This slide goes through the things that will not be included in the leases when we look at them. I'm going to assume a lot of these will not apply to most school districts. The two I did want to highlight though at the end, it talks about subscription-based IT agreements. This is not included only because GASB 96, which we'll touch on later, addresses that. So any of those type of assets, any software type things are not going to fall under this. Also, any non-exchange. So if you are getting a building lease and let's say the city in which you're in is donating a building, or not donating, but leasing a building to you for $1 a month. That is not going to qualify because again, there's not an exchange there. They're pretty much just letting you use it for free, essentially. So that is not going to be included either. On the next slide, the other thing that is not included is short-term leases. And so according to the standard, a short-term lease has to have a maximum or no more than a 12-month period. What gets a little tricky is that it also can include any options to extend beyond that initial period. So let's say you had a 12-month lease, but there's 2 extensions for 2 additional years. That has to be included, so therefore it's no longer a short-term lease. And it also talks about how, which we'll get into later, when you're actually determining those options, that you have to determine whether you're actually going to exercise them. Unfortunately, for short-term leases, that does not apply. So it'll make a little more sense when we go into that part of it. But basically, if you're looking at a lease, it's a year long, but there's additional extensions available for time, then it will not fall under the short-term lease. So we will have to consider it. Another thing to note that these leases are not going to be like your capital assets as we have done with capital leases. Your capitalization policy, as far as the assets that you actually capitalize over your threshold, this does not apply to lease assets. So we're going to be looking at materiality, but your capital lease policy will not play into whether or not these are recorded. Just some things to consider while we're doing this implementation. Obviously, we're going to identify all the leases. We're going to go through a spreadsheet that we have set up to start tracking all of those and determining whether those are going to qualify under the standard. We're also going to look at if they're material, as Kevin already mentioned. Some of this stuff is just not even going to be material. Again, it's going to be on a case-by-case basis. What could be material to one district may be very material to another. So we'll have to look at it for each individual district, but that will definitely come into play. The other thing that will be that we'll look into is whether there's a purchase option at the end. So if you are leasing something and at the end the assets are yours, or you are going to purchase those items at the end, then it's considered a financed purchase. Make sure I got that wording right. And so therefore that doesn't fall under a lease because again, you're not giving the assets back, you are keeping them. So it's just like long-term debt. So it'll be kind of similar to what we've done with capital leases. You'll have the fixed asset and then the long-term debt associated with those. And then this is just an example of kind of what we just talked about. If you lease computers, and at the end of the lease, you have the option, the students are able to purchase them from the school district, but regardless of whether the students actually purchase them, the school district is required to purchase them at the end. And there are no termination options within that lease. Then the question is that a lease or a finance purchase? And so based on the criteria and the fact that everything transfers to the district at the end of the period, it is a finance purchase. So again, that's going to be a long-term debt situation and will not fall under this standard. So on this slide, this just kind of gives you an idea of where you can start to look as you start to determine what leases there could be out there. And these are similar things to what we are going to look, because as Kevin mentioned, we're going to have to do a search for unidentified leases. And so these are the things that we are going to look at as well. But these are at least where you could start. So reviewing any rental expense GLD, their accounts, if there's certain ones that you know that's where all the rental payments go into, you could look there. Definitely look at any capital leases that we have recorded in the past, because those will definitely probably fall under this and need to at least be looked at. Also looking at any current construction projects. Sometimes people begin to lease new things as part of new construction or different things going on. So just being aware if that's going on, just to look at that. Also evaluating all other contracts. So again, you may have service contracts. And again, materiality is going to come into play, but there may be some that actually include assets as part of that agreement. So just making sure that you've looked at those. And then also just talking to the other departments within the districts, specifically IT, maintenance, and transportation. Those seem to be the ones that typically have these type of contracts. So you very well may be aware of most of them, but having a conversation with them definitely does not hurt.
Okay. So now we're going to jump into some of the definitions of the lease term. So some of this is kind of going to be kind of a repeat a little bit, but it's kind of hitting on some of the same things. So, you know, you guys get a good understanding of this. So basically, you know, what is the lease term? Basically includes the period that a lessee has a non-cancelable right to use an underlying asset. So basically what that term is that right. So as Sheridan mentioned, it can include the following periods as far as the lessee or even the lessor's option to extend and or terminate. So like mentioned before, you may go into a lease that may be for 1 year, but you may have 5 periods to extend it out each year. If at the beginning, when you're looking at this lease, you know, you have those extension periods, so you have to analyze it at least and see whether or not you would extend it. If it's reasonably certain that it will be extended, then you take those options to extend as part of the lease. So if you had a 1-year lease, 5 extension options, you're like, yeah, we're going to extend every single one of these for sure. We know we're going to. Then you have a 6-year lease. So that's how to look at it that way. So reasonably certain, as far as the definition, there really isn't a definition. It's more so it's professional judgment. You know, what you guys think is really going to happen at that certain time. As we'll get into a little later, these things have to be looked at each year. So I mean, you could make a decision at the beginning of this that says like, hey, we're going to extend this all 5 of these extension terms. 3 years down the road, you may get down there and say, oh yeah, this asset, whatever we're using, it's terrible. We're going to move on. We're not going to extend this past there. So you would have to go back and do a reassessment. We'll get into that a little more. But you kind of have to look at it each year. So initially you're looking at it, your professional judgment of what do you truly think is going to happen. Some of these things like this economic incentives, you know, maybe it's a great deal. So you think there's a good chance you're going to extend it just because of the deal you're getting on it for the extension periods. So essentially it's going to be, it's less speculative than probable. I mean, if you think it's probable, that's likely the way you're going to go at that point. So other considerations, this was something that in a lot of the trainings we went through that was mentioned and was applicable to governments, is whether there's some sort of fiscal funding or cancellation clause that could affect the term. So essentially what this is some agreements will have basically an annual out for you guys, you know, based on maybe funding sources change or, you know, budgetary constraints change, so you have an out each year. That essentially is the same thing as an option to extend. If you think you're not going to use this cancellation clause, then continue on with the lease. If you think it's going to be canceled for whatever reason, then the lease, you're assuming it's going to end as of the date that you implement that cancellation clause. So again, same concept as before as the extensions. It's really looking at your professional judgment of whether or not you think you're going to continue on with the lease or not. Some other considerations. This is more like kind of what I mentioned as far as reassessing the lease term. So, you know, if later on you decide you're not going to elect to exercise, or you know, maybe even the opposite of one that you initially determined it to be short term because you thought you weren't going to exercise it, and then you did. You may have to reassess it. So essentially, some sort of event that has happened that is going to require an extension or termination, you have to reassess that lease each year, and adjust for it on the government-wide financial statements, however the adjustment takes place, whether you're going to take it off early or you're going to extend it out further. What this does not include in the lease term are basically any periods where the lessee and the lessor both have the option to terminate the lease without the permission of any other party. At this point, it's kind of, I mean, if you want to think of it in simple terms, more so like, you know, a streaming app. You can get rid of the thing whenever you want to. It's really a month-to-month lease at that point. You know, you get the streaming app, you watch your 5 shows, and then you cancel it, and it's gone. It's a month-to-month thing. So that's more of how that goes. If that's you have the ability to do that, then it's a short-term lease. Essentially, it's month-to-month.
All right. And now we're going to go through the accounting end of it. So on the first slide, if you can, that's okay. So the good news is on your side, nothing's really going to change. If you, as you've had in the past, you would record an expenditure and then in other financing sources when that lease was initially set up. And then you would continue to record the payments as you always have with any other type of rental or lease agreement. So that's going to be on the government funds or governmental funds. So nothing changes on your end. Really, all that's going to affect is your government wide. So on the next page, as far as the lease liability and the lease asset, those are going to be the two things that are going to be set up when we record these. And basically the liability that's going to be put on the books is no longer just whatever you owe on this lease. It's going to be the present value of the expected payments. And so that's what we're going to record the liability at, as well as then that's essentially the other side of the entry is going to be the asset that we're going to record. The different things that could be included in that lease liability, obviously any fixed payments you're making, so the monthly payments you're making. There's also some agreements that there may be some variable costs that are somehow associated with an index or a rate. Some of them may have a maximum minimum amount that may have to be factored into. And then if there's amounts that you believe are going to be reasonably certain to be paid regarding any residual value guarantees. So these are all potential. Obviously, you're going to have the fixed costs, but then there may be some variable items that we'll have to look at as well. So all those would be included in the lease liability. Then in order to get that present value, we are going to have to use a discount rate. Normally, if it's equipment or some type of asset, sometimes the lease agreement actually tells you what the interest rate is that they are using to calculate it. Sometimes you know the value of the asset, and then you know the payments, so we can back into what that interest rate is. Other times, it doesn't have any indication. This is more likely when you're just leasing space or a building. Typically, you're not going to have an interest rate listed. So that's where this discount rate is going to come into play. And really what we are required to use then is your incremental borrowing rate. And so this would be the rate that you as a district would have if you were to go out and get debt. So of course, there's a little bit of caveat on this whole thing because you can't just look at, oh, we went out for bond last year, this was the interest rate, and so that's what we can use. Because again, that was possibly a 20-year bond for a new construction project. And what we're looking at is a lease for, let's just say, we'll just say copiers. And so they're very different type of debt agreements. So we actually have to look at something that is similar to what you're going to be leasing or debt that's similar to that. So there's a lot of factors that go into it. We're looking at how the creditworthiness of the company or of the government, if it's a secured or unsecured loan, if there's collateral related to it, also the term, the structure of the payments, all of that is going to factor in. And we had received some guidance as far as a website that we could use, because the best way to do it would be to pull up other municipal debt within the area or within kind of around where you are at. So within the same county, and just kind of see what rates are for other districts if you don't have something that we can use. Unfortunately, this website, it does require a fee in order to be able to access the information. So we're looking to see what other alternatives we have. So we will definitely let you know as soon as we know how we're going to do that. But that's gonna how we're gonna have to figure out what that incremental borrowing rate is. So then once we have that, then we're going to do the amortization, which is just going to be similar to how you would do any long-term debt, any lease in the past. But again, it's going to be based on the present value. And so we're going to figure out what that amortization is, and that's what we are going to be recording each year to bring down the asset or the lease asset and lease liability each year. Then, as Kevin mentioned, every year we are going to have to look at the leases just to make sure that there's nothing that would have triggered a change that would require us to measure it. So if there was a change in the lease term that you weren't expecting, if there was something that you assumed you were going to take as far as an option or you weren't going to take and now for sure you are, and then there's some other things there as well. All of those we're just going to look at, just make sure there's been no changes. And if so, then we may have to look at whether it's material enough that we should remeasure the liability. If we do have to remeasure it, on the next slide, you adjust the asset as well as the liability. And then if there's any difference between the two, then it's just a gain or loss. And again, this is all on the government wide, so nothing you guys have to worry about internally.
Okay, so now the next section we're going to go into is the lessor accounting side of things. So it's really very similar to the lessee accounting. So I mean, we've talked a lot about, you know, how you guys book the asset, book the liability. It's going to be very similar, except in the case of the lessor, you have a receivable essentially, and then deferred revenue. That's really going to be the main difference. The calculations themselves are the same. The term, determining the terms of the lease are the same. You know, the discount rate, all that stuff, that's all the same. You're just on the other side of the transaction, basically. So as I mentioned, you know, the discount rate is going to be the interest rate that the lessor charges. So, you know, if you guys have an agreement where you guys are leasing something out, whether it's a room, a building, you know, whatever it is, if you actually have an interest rate spelled out in there, I mean, that's what's going to be used. If there's not some sort of stated rate, just like we went over, I mean, we're going to have to determine what that rate is. So, I mean, most cases, we're going to have figured it out on the lessee side at some point for something. So we'll most likely have it. If you have a lessor transaction, you likely have a lessee transaction where we've done this. So it should be fairly simple at that point. Same thing as far as remeasuring the receivable, you're going to run into the same issue as with a lease. Each year you're going to have to look at it and determine, you know, are you going to kick somebody out of their lease? You know, they're destroying your building. You know, we're going to get them out of here. We're not going to continue this thing. And so we'd have to look at that each year and do the same thing as far as remeasure to see if the receivable and the deferred revenue need to be adjusted at all because of this. same concept as you're going to reduce the asset first. And then if whatever's left over is going to be treated as a gain loss, again, it's going to be on the government-wide financial statement. So, nothing you guys are necessarily going to have to worry about for the fund financials. It's just going to be an annual thing we're going to have to look at, discuss with you guys on, has anything changed with this, building that you guys are leasing out. Financial statement impact. So this is going to kind of go over some like where it's going in the financial statements, where disclosures are going to be, what needs to be disclosed. You're going to find a lot of this is pretty similar to like a long-term debt footnote, really, and even the capital asset footnote. They're going to be included a lot of things together. So the first thing is, like we mentioned earlier, the operating lease terminology is gone. The operating lease doesn't exist anymore. So any operating lease footnotes that are out there will be gone. Those will be deleted. The lease asset disclosures, you're going to lease the total amount of leased assets that are out there, and the total accumulated amortization. So very similar to capital assets where you have the total assets and the total accumulated depreciation. And then the lease liability disclosures, you're going to have a general description of the leasing arrangement, as far as the basis, the terms, the conditions for any variable payments, if there are any. As Chair mentioned, if there's any residual value guarantees at the end of the lease, things like that are going to be disclosed. All the principal and interest requirements to maturity for the next 5 years, and then in 5-year increments after that. And then any commitments under the lease before commencement of the lease term. So again, very similar to a long-term debt footnote where you list, here's the debt, here's the terms of the debt, here's the payments going out forward. Then just some other disclosures that potentially are going to be applicable. So any outflows of resources, recognizing the reporting period for variable payments not included in the initial measurement. The amount of any outflows recognized in the reporting period for any other payments, such again as residual value guarantees if they exist, any termination penalties if something was terminated early that were previously not included in the measurement, and then components of any loss associated with an impairment recognized. So something was terminated early and you guys had some sort of an impairment loss because the receivable was impaired, type thing. Again, these are only going to be things that are going to be disclosed if they actually occur. So again, this is part of the thing as far as when we go over these with you guys each year and determine if anything significant has changed. These are some things that could come with that. Again, these are all disclosures. So likely are going to be things that, we're going to be doing with the report write-up. Again, removing the operating lease disclosures for the lessor. And then same thing on the lessor side. General description of the leasing arrangements, where you're going to have how the receivable was determined, and what's made up of that receivable, and then the same kind of thing, total inflows that are received out there. So this is going to be kind of similar. You guys have had a quote unquote operating lease for things you've leased out. If you leased out a building where it's described those terms and what those payments were, this is going to be very similar as far as disclosure for the lessor and you guys leasing something out. Same type of disclosure, similar for the lessee, as far as you're going to disclose the amount of inflows from any variable type payments that weren't initially factored into the lease. Also, the same type of thing. This next one isn't the same type of thing necessarily. It's more something that occurs, and I highly doubt it's going to occur with most of you guys. Is the existence of if you issue debt that's secured by some of the lease payments. So I highly doubt that you guys are going to be issuing debt that's solely relying on the amount of money that you're obtaining in a lease. That's what that would be. So that would have to be disclosed if it happened. I doubt that that's going to happen though. Then also same type of thing. On the lessor side, you're going to disclose the future minimum payments under the lessor agreements for the next 5 years and then in 5-year increments after that. Then just kind of some visual examples of how you guys are going to see this on the financial statements itself. So this would be an example of your statement of financial position here in a lessor transaction. So in the maroon type arrow, that's going to be the lessor transaction. In that section, of the assets, you guys would have a leased receivable now that would show up in there. On the green arrow, that's going to be the lessee side of the transaction. So when you guys are actually leasing something now, you're going to have a change to the building, property, and equipment section. So it's going to look very similar. Instead of net of depreciation, it will now say net of depreciation / amortization. Because as you see, when we get a little further in, the leased assets are going to be included in the capital asset footnote. Then down to the liability section. So again, for the liabilities for the due within more than 1 year and the due within a year, as a lessee, that's not going to change, because again, when we get to the footnote and seeing how that goes, it's going to be included with the long-term debt footnote. So this is all going to tie back to there. So no real change there. However, for the lessor, there will be a change. You'll have another deferred inflow, which will essentially be deferred revenue for future revenue that you expect to collect under the lease. So then statement of activities, not a big change. This really is only going to be a change if you have unallocated depreciation. So obviously, if your depreciation is allocated to all your programs, it's no change. The amortization will just also be allocated to the programs in the same manner. But if you have unallocated depreciation, it will now say depreciation / amortization unallocated. That's just noting that both of those are in there. So here's an example of the capital asset footnote, how it'll look. So you guys are used to the table and how all that's presented. So the fixed assets themselves are going to stay the same, but you will have here, down here at the bottom, the lease and subscription based IT assets. So this has the subscription IT assets as the GASB 96. We just put this in the example together because they're going to go in the same spot. But the lease is going to just be presented at the bottom. That's going to show as net of the amortization. Then below that table, there's usually a table that shows how the depreciation is split amongst the programs. So in this case, again, like I just mentioned, if it's split amongst all your programs, it's going to show how the amortization was split against the programs along with the depreciation. And again, you'll have your unallocated number there as well. The main change will be that it will note that it's depreciation and amortization. Then the long-term liability footnote. So again, this is going to be combined with everything. So in the long-term debt, you will have the lease and purchase agreements and also the lease and subscription IT liabilities down there at the bottom. So again, this is all going to be combined in there with the footnote itself. So it's going to be in one spot, and you're not going to have separate footnotes per se, but you will have the separate descriptions in where they're similar to the long-term debt footnotes. And back to Sheridan then for some additional resources.
So the next few slides are just some summary of kind of what we already went over, just kind of gives a more visual of how this will work for some of this, for the initial recording and remeasuring, et cetera. So there's several slides there. So if you want to go down, Kevin, I think there's probably 4 or 5 slides. And then what we're going to do at this point then is go through the spreadsheet that we are going to be providing to you, that we're going to ask that you fill out. So as Kevin brings that up, really it should be pretty straightforward. That was our goal anyway. And really just walks through the various parts of the standard and what we are going to have to be looking at to determine whether it qualifies first, and then the information we need in order to be recording it. So this is the spreadsheet that we have set up. And there's an example on the top that you can kind of use as you're beginning to enter this information. So I'll just quickly go through this, and obviously you can ask questions once we're done. But you'll list any agreement that you feel could be, that could qualify under this. So for example, this was a copier lease. They had 5 copiers. And all this information is just coming from the lease agreement that you would have. The lease term is for 5 years, and after that, there are 3 one-year extensions that they can use. The government can cancel after that first 5 years. So we just need the contract and start date. This value is just the total payments that you're going to make. So as you'll see over a little further over, they're making $1,000 payments for 60 months. So that's how we got to the $60,000 that they'll be paying over that 5 years. Then the $36,000 is if they determine let's just say they are going to take the 1 year or the 3 one-year extensions. That would be where that $36,000 came into play. So the incremental rate, this is going under the assumption that the agreement listed out that rate. So it did have the 6% on there. So you would list that there. Again, the monthly payments, the number of payments. Then the next section is the rest of it's really yes or no questions, just to determine whether this truly is going to fall under the lease standard. So the first one is, did the assets transfer or will they transfer at the end of the agreement? If the answer is yes, and you change that to yes, it will actually indicate then over on column. Oh, it's not working.
Broken there.
All right, we'll fix that. So if there was a transfer, then it would be a lease purchase or finance purchase. It will not fall then under this lease standard. Also, you can indicate whether there was termination.
That's what it is. It's looking for both. So both of them are.
Oh, got it. Okay. Then that would affect that. Then as far as then the other questions that are related to the standard, just to make sure that, again, this lease does fall under that, needs to be in writing or verbal, but it needs to be legally binding. So yes or no. If you say no, then it's not going to be subject to the lease standard. The right to present or have I'm sorry, it's really small. I'm trying to read it. To use the asset. And then the next one is the right to determine how you're going to use the asset. So if all of these are yes, and then the last one is just if it's 12 months or less. If it is more than 12 months, then it's going to fall under the lease standard. So in this case, since we said that over on the under the financing purchase that yes, it did transfer, then over here in column U, it's going to say no, it does not. It's not subject. So now that Kevin changed it back, it will show that yes, it is. We also would ask if you can tell us what GL account that all those payments are going into. That would be very helpful so that we can just easily pull that account and pull out those numbers. And then any notes, obviously we would like you to do your best to fill this out as much as you can. We know you're going to have questions, or if there's just some things you're just not sure on reading the agreement, whether it qualifies or not. We just have a place if you want to make notes there, and that way we can discuss it when we come out. Also feel free if you want to contact us in the meantime, that is all right as well. So this is what we are going to ask that you fill out. Based on this, then we will calculate the amortization table, which is what this next tab is. You don't need to do anything with it. This is just what we're going to use to get that present value of future payments. And then we have a similar tab if you are the lessor. So if you're leasing something out, it's pretty much exactly the same thing, just putting in that information from the lease agreement and then determining whether it qualifies or not.
Pretty much, yeah, everything's very similar as far as all the different things to look at.
Right. So that's the lease standard. I know there's a couple questions in the chat. So as far as if you have leases and at the end you own the assets, then it will be considered a finance purchase. So this does not qualify. So Yeah, any of those, which they may be several of the capital leases that you currently have that may fall under there. And actually, if they do, if we can push them to be a finance purchase, that would be ideal because it's just going to lessen the number of items we have to then do under this standard. So, and then there was also a question about the wording for the subscription IT assets and what are examples of those. And we are actually going to go into that right now. That is GASB 96. So we'll kind of go through that. As Kevin had mentioned, the AICPA has, and I know this, a lot of the larger national firms are encouraging their clients to implement both. We are leaving it up to you. For some people, it might be easier to look at both standards since they are somewhat similar, to just do it all at once and be able to just get it all done in 1 year and not have to divide this between 2 years. Others may determine that it's just too much to have to look at both. And so it'll just be easier for you guys to do the lease this year and then do 96 next year. So we are leaving it up to you. Obviously, if you want to talk through what we think is best, we can absolutely do that. And also the other thing that will come into play is cost. As we are implementing these, it's obviously less time on our part to implement them together, because the footnotes, everything will just change once this year, and then we don't have to worry about it next year. If you choose to do it over 2 years, there will be a little bit additional cost just because, again, we're going to have to change footnotes this year and then change them again for the 96 next year. So just some things to consider when you decide how you want to implement these. So it looks like that's all the questions for now. So we'll go ahead and go into 96, and then we'll open up for questions after that, in case there's any more.
We're actually doing pretty good on time too, so there should be plenty of time for questions, because a lot of this, so we're going to get into subscription-based assets now, and a lot, like we had mentioned before, a lot of this is similar. So it's really going to be going over some of the terminology on what a subscription-based asset is. Again, some of this stuff is going to be professional judgment on what you consider to be a subscription-based. I mean, a lot of softwares for sure are going to be, but there's some other things that there's not just a list out there like this isn't type thing. So some of the things may have to be considered. One of the questions I think's come up is, like a book, like you get online access to a book. What is that? I think from our side, right now the thought is you really don't have the right to determine the use of that book. I mean, it's a book, you read it. You can't go and modify the book. You can't, change the chapters around, like move things like that. So like you really don't have the right to determine how it's going to be used. I mean, it's going to be used to be read, and that's it. But as far as the software, you guys get your financial accounting software. You're able to determine what reports you want it to do. You're able to determine what goes into it as far as what transactions you entered, what modules you use, what modules you don't use. So that type of thing, that's some of the things to consider. So we'll go into this a little more and some of the definitions. Like I said, if you guys got questions at the end, we can go over this some more too. So this is effective for fiscal year ends 6/30/23. So like Sheridan mentioned, we got another year for this, but they are recommending early implementation. This was just something that recently the AICPA did. I think you guys did a seminar in like February where they started recommending this. Because I know a lot of you guys, we kind of talked to like, hey, worry about the assets now, we'll worry about subscription based later. That's what everyone was rolling on as far as the assumptions. And then the AICPA came out and said, yeah, you probably should consider your early implementing just because it may be easier because you're looking at everything at once. So it makes sense, but it's not required. So the definition, so you're going to see the definition is very similar to what we just went over for a tangible type asset, but it's basically a contract that's going to convey the right to use another party's subscription-based information technology asset. So basically their software, whether it's in a loan by itself or in combination with, a capital asset that they're providing you. So, and it's going to be specified in a contract for a period of time, and it's got to be an exchange-like transaction. So again, the exchange-like transaction, the key thing there is, if somebody else you're using this from and they're charging you $1 for it, it's not really an exchange-like transaction. So I mean, that's likely not to occur with subscription based, but it's the same kind of concept. So again, same type of thing. You know, what control is. Control is the right to obtain the present service capacity of the asset itself, and the right to determine the nature and the manner of use. So that's kind of where I was going into. Yes, you have a subscription to use a book, but do you really have the right to determine the nature and the manner of the use of it? Um, so those are the things to consider. Again, it's going to, same thing as the assets, the tangible assets. It's going to include any contracts for service type contracts. So if you have a service just to maintain, or like a contract to maintain a certain IT function, you know, with an IT company, and all they're doing is maintaining it, you're not actually using any type of software. That doesn't apply to this. Um, so various subscriptions that are excluded. So any kind of lease where the software component is insignificant. So for example, if you have some sort of a lease for an asset, and you know, like a computer, let's say, and it's got an operating system on it that, you know, technically is part of this thing, that is such a small piece to the computer itself. Don't need to do anything separate with that. Just do the lease for the computer. You're done. You don't need to break anything out for the software that came with the computer. Um, then any governments that provide the right to use their IT software, and associated tangible capital assets, through other entities. Again, I don't know that a lot of this is going to occur, but that's just something that's out there that they specifically identify that doesn't apply. Um, public, private, or public partnership contracts. Again, I don't think this is anything that's really going to apply to any of you guys. This is more so things like, where did I have this? There's another GASB 94. It's similar to service concession agreements. So basically, like something where, you know, there's an asset that's being leased and is involved in, basically you're leasing it out to somebody else. They're controlling it and using it. Like one of the examples is like a tollway, like a city or some sort of larger government is leasing out their highway tollway function to another company, and they're gaining money off of the tollway, and the government's collecting the fee. So not something that is likely to occur with you guys, but again, it's something out there that's excluded. And then any kind of licensing agreement for a software that's a perpetual license. Essentially, what that is you go buy the software and you pay a one-time fee and it's done. There's no subscription to it. Essentially, you pay it up front and it's done, and you can use it for as long as you want to use it for. And again, like you may have a service component to it where there's service that you're paying, you know, on an annual basis or something like that. But that's the service piece that doesn't get, you know, that's not included in these. And then this is just kind of some general, again, probably not a whole lot of things that you guys are concerned with. It kind of just gives you different terminology. I mean, your IT guys are probably more in tune with what all this is saying, but this is just going over the types of cloud computing that are out there. You know, like what types of things that could occur that would fall under this lease. So this would maybe be a good slide once you get to subscription based. You know, if you're going to do it this year, if you're going to do it next year, but it brings to the head of your IT department, or whoever the head of your IT department is, and say, hey, do we have any kind of you know, lease type situation that may include one of these types of cloud computing functions? I will tell you the main thing that's probably gonna you know, affect you guys is, I know a lot of your guys' financial software is moving to a cloud-based system, and you guys are paying, you know, a monthly fee, and you have a contract for that, you know, instead of just paying for the software up front and it's just on your server. Now it's the cloud computing thing, and there's a monthly fee to it. So that's going to be one of the main ones that's going to happen with this. You know, you guys could have different kinds of storage, cloud-based storage that you guys are paying for on a monthly basis and have a contract for, that type of thing. So those are some of the more common examples. Again, there's no perfect list of yes, this is, yes, this isn't. So what I would say in most cases, if you go over this with your IT department and they say, yeah, this could be potentially, put it on the list and at least make some notes, like here's why we think it may be. And we can at least go over it at that time.
All right, now we're gonna just go through the subscription term and what that is. The good news is this is kind of similar to the other part, pretty much identical to the lease standard. So just as far as the term that the subscription, when you're looking at the term, the period that it's going to cover is going to be what the non-cancelable portion of the right to use the asset, as well as any option that you are reasonably certain to exercise. So if there's an option to extend, an option to terminate, and it's more than likely you are going to exercise that, then that would be included in the term as well. So again, very similar to what you saw with the lease standard. Considerations for whether the options will be extended or be exercised. So again, when you're looking at those options after the initial period, these are just different things that you can look at and evaluate with your IT, your head of IT, just various things related to IT. Do you think you're actually going to be using this software? Will it be more obsolete at the end of the period and you're going to have to find something new? Or maybe it's just not as useful as you thought, so you're going to more than likely get rid of it. Or you've been pleasantly surprised. It's awesome. They're making some great upgrades to it. And so you think you're going to keep it longer than you intended to. So all things to consider when you're determining that lease period. And then similar to, again, the lease standard, these are the various things that could go into that initial liability and the payments. So again, fixed costs and payments, and then all the various variable payments, penalties, et cetera, that could be part of that agreement. This is where this is going to differ a little then from the lease standard. So I'll just take a few minutes to go through this. Unlike lease for an asset, sometimes software can get a little bit more complicated because there are different stages of implementation for that software. And so we're going to go through each of these. There's a slide for each of them, but basically it divides it between just the preliminary before implementation, then the actual implementation phase of the project, and then kind of after it's been put into place and the follow-up afterwards. And so those are going to be the three categories that we're going to look at more detail. So the next slide then talks about the preliminary project. This is more kind of like the exploratory part of kind of determining what software you're going to even use. Maybe you have a consultant helping you out, so there's costs associated with determining what software is going to be best for the district, working with the different software companies to test it, figure out which one is going to work best. All of these are going to be expensed. So these will not be part of the actual asset. These are all just expense as they are incurred. Then when we get to the initial implementation, this is where you've picked the software and now the company is going through and testing it. They're configuring it for your district. They're doing the coding, installation. All of that is going to be capitalized as part of the asset. The other thing that can fall into here is if there's data conversion that needs to happen and it's needed in order for you to be able to actually use the asset, so that data is very critical to you being able to use the software, then that part of it should be capitalized as well if there's costs associated with that. So that's the implementation stage. Pretty much all of that's capitalized. Then after the asset is actually in place, so that implementation period pretty much ends when the asset has been put into use. And so after that, then obviously there's always troubleshooting, there's additional training you may need, there may be maintenance, etc. All that's going to be expensed as incurred. Sometimes there's new modules or things that you want to buy, and Kevin will go through that in a second because you'll kind of have to reevaluate and determine whether that is going to change the actual liability of that.
Okay, so now getting into some of the accounting, how some of this stuff is going to show up, type thing. Some of it's going to be a little bit of a repeat and clarification on what Sheridan just went over, but it's kind of give you guys an idea on how some of this stuff is going to actually happen. So again, this is kind of going over what Sheridan just did as far as expensing these items is when they occur. So basically think of these things as like the R&D, like you're just figuring out what you're even going to buy. So you're not going to capitalize that because you may have a ton of different stuff you looked at that doesn't even apply to the software you ended up buying. So just think of it kind of like as your R&D. Then other things after the fact are things that are going to not necessarily apply to the actual use of the asset or putting it into use. So like Sheridan said, training costs that happen after the fact, troubleshooting, converting data that, like Sheridan said, if you have to do it in order to put the asset into service, capitalize it. But if it's just we got to put a bunch of vendors in type thing, so we have all the vendor's address, things like that. That doesn't necessarily stop you from using the software. I mean, you could use the software and enter the vendor in as you cut a check. This as far as like converting the data and importing that so it's there. That type of cost would be expensed. So things that would be capitalized. So additional outlays, things that may have happened. Later on, you decided I'm going to add, let's say for example, fixed assets. You guys have had us track that in the past. You guys get a new software, you implement it, and they have a fixed asset module, and you're like, hey, we're going to try and do this on our own. And you add a fixed asset module to that contract then. So you're paying more. You got a new module that's increased the functionality of the asset, and is also increasing the efficiency on your guys' end because you guys are tracking this all up front, type thing. That's added to the contract. You would want to capitalize that as an additional piece to this contract then. So just think of it that way: is that you've added a new module onto the software. Then recognition. It's pretty similar to a fixed asset. I mean, it's essentially, yes, subscription term is going to be usually when the asset's placed in the service. I mean, that's when they're going to start charging you for it, type thing. So basically, that's really when you're going to place the asset into service, because in most cases they're not charging you for it until you're actually using the thing. And any payments made prior to recognition, sometimes like maybe let's say you got to pay 50% of the annual fee up front, type thing. That's not going to be any different as far as just because you paid it up front doesn't mean it's not going to be capitalized. It's going to be accounted for as a prepayment and part of the payments to value the total amount of this lease. And then this kind of is similar to some of the other things as far as when we look at where you're going to have to look at these on an annual basis. Is same kind of thing. You're going to look at these each year, make sure that the functionality is still there, make sure that it hasn't become obsolete. Just the various different things you're going to look at on an annual basis to make sure you're going to continue to use it for the period that you originally thought you were going to use it for. If for some reason, let's say it's obsolete, they came out with a new software and it's much better and you're going to get rid of this one, then it's, at that point, then that lease asset is likely impaired. We're going to have to reassess it, and you may have a loss for the impairment of the lease asset because you're going to move away from it. Then various incentives. I mean, incentives have been mentioned a few times throughout here as far as how they're accounted for when you're valuing the lease. Is essentially if there's incentives that are going to happen because you've signed a 5-year contract as opposed to a 3, or there's just a certain incentive out there for school districts. If you use this software, something like that, you're going to want to take that into account as far as the value of the lease itself. You're going to take the incentives into effect at the beginning of this. If the incentives, like I said, they're going to be included in the initial measurement by directly reducing the subscription asset. And then if the incentives occur after um, commencement, as far as like you're going to get incentives later down the road, like maybe year two is cheaper type thing. Some softwares will do that where here's your year one price. If you're going to extend it beyond, we'll give you a year two a little cheaper type thing. You're going to factor that in as far as the value itself, and when we do the present value calculations, that will be factored into as well. If it's the key to the incentives though are they have to be somewhat fixed. Like you're going to get X like at the beginning of this thing. Um, the variable thing I don't think is going to come much into play for you guys for the software type stuff, because usually the variable thing is like, hey, if you use this X amount of times, you're going to get some sort of discount or things like that. Like I just don't know that it's going to come up that much, but either way, it's not a big concern because the variable type things you don't factor into the initial measurement of the lease. The variable things you basically take those as they come because they are variable, and at the beginning you don't know if you're going to meet those or not. The next few slides then have to go with contracts with multiple components. I mean, you could technically have this with an asset itself too, but it's a little less likely in that case because usually you're leasing one asset and that's it type thing, or one type of asset. Whereas a subscription based technology, you could have different things. For example, like I just mentioned, modules. You could have different modules for things. We'll get into a little later. There's a couple slides where it talks about combining, and if they're all for one specific purpose, then you combine them. But just for sake of discussion, we'll use the module example. But let's say you have a subscription based contract for two different modules. They're not related at all. They're used for two different purposes. So you're going to separate those because you could technically have different terms on these things. You could have one for 5, and they could even both be for 5, but you could determine that one is going to be, we're only going to use this for 3 years. So you could have some differences there. Again, I don't know it's going to happen a lot, but just realize that that's a potential thing out there as you're looking at a subscription-based contract for some sort of asset, that you could potentially have some differences for something like different modules or different types of IT assets. And I mean, you could even have some separate, they have examples of non-subscription components. You could have something for a subscription of some sort of module, and then that module is maybe an attachment to a perpetual license. So let's say you bought a software, paid for it up front, it's done. That's not a subscription-based agreement, because you basically just bought the software and you're just going to capitalize the software like a fixed asset. But then let's say you added on top of that a payroll module that you're paying for each month, and it feeds into that, and it's a different contract. So you could that could be something that could be similar to. So really, the main component of that is if you have something like this, you're supposed to separate it and determine the contract price for each separate section. So like I said, if you had 2 modules, we're using them separately, they charged you $100 for the 2 of them together. There would have to be a determination of, hey, am I paying $50 for this one, $50 for this one, or am I paying $40 and $60? A lot of times contracts will note that or give you that. Sometimes they won't necessarily say it, but they have separate pricing, and you can figure it out that way. So if it occurs, you would have to figure out the separate pricing for each component of the contract. So this is what I mentioned earlier, and I think probably in most cases, this is what's going to apply, is the combination criteria. So contracts are basically negotiated as a package with a single objective, are going to be considered one. So back to the module example, when you guys purchase a financial accounting software, you buy that for the financial accounting objective. Every module you purchase with that is for that function. So you have your financial accounting, and you have a fixed asset module, and you have a payroll module. They're all intertwined. You're using them all together. That was the purpose. That's going to be one asset. So that's why I think a lot of the separation for these, you guys aren't going to have to worry about too much. And a lot of these things are going to be combined in most cases. Like I said, if you guys have questions on this when you're looking at these, whether you let us know up front or make some notes in the spreadsheet that you think there may be something separate, then point that out. Then as far as modifications, terminations, this is very similar to the actual lease piece itself, as far as if there's amendments, or if you decide not to extend, or you decide to terminate early, then essentially we're going to have to do the same thing on an annual basis, look at these things and potentially remeasure if one of these things occurs. So no real big difference there. That's pretty much the same as the lease standard itself. So again, same type of thing. You're going to modify if necessary. And like we mentioned before, this could be the other way too. You could modify because you added something. If you added like I said, the fixed asset module example, you added that, then you would remeasure the lease with that additional fixed asset module in there as well. If this kind of goes into like if it just modified the original contract, so if it was combined, then there's no, you're remeasuring that specific liability. If you added a module to some sort of contract that had nothing to do with the financial accounting software, like for example, like, I don't know, something, you added some sort of module under a contract with the financial reporting software to track attendance, let's say, at the school district, there was some sort of additional module for that. That's really got nothing to do with the financial reporting aspect of it. That's a separate module, and then you're going to treat that as a separate contract. You would just reassess that as a new contract, essentially. Terminations, I mean, this is pretty similar to the assets, almost exactly the same as, if you decide you're going to terminate this thing or you reduce the term of the lease, it's going to be remeasured, and you could potentially have a loss for the difference when adjusting for this. Again, this is very similar to the accounting for the lease itself. For your guys' side on the fund financial statements, it's going to be the same thing. You have other financing sources and uses in the original period that you recognize this thing, as far as a credit for, this is the total amount that's received, and then a debit for the expenditures that were related to it. So kind of similar to when we would book a capital lease on there. This is going to be related to the lease standards, and then payments are just going to come off like a long-term debt item on the government-wide financial statements.
So as far as financial or the financial statement impact, it's really going to be exactly the same as what you saw previously, because we had included that wording already. So we didn't repeat all those slides again, but it's exactly what you saw before. The footnotes, there's just 2 slides here with the notes that we will be adding. Again, very similar to the lease standard, just information on the agreements, the details of that, any outflows, and then just amortization, etc. So again, pretty much exactly what you saw with the lease standard. Then after that, there's just some additional resources, and Kevin, if you could just scroll through them. Just a few slides on the initial recording of them. Again, it's just everything that we already went over, just in kind of a different format that may be a little bit easier to understand. So those are in there for you as well. We do also have a spreadsheet that we are going to use for 96. It's basically exactly the same thing as for the lease standard. If that's something that you do want to go ahead and do both this year, that is absolutely fine, and we can send that out. We just didn't include it in here, but we can definitely get that to you as well. It doesn't look like we have any other questions. We did at least want to kind of go through how we are going to be billing for this. and what you can do to help us as far as minimizing the additional costs associated with these implementations. So the initial cost just for us to come in and do the testing, again, kind of like we said, kind of like for what we do for accounts payable, we're going to have to at least test and verify that the lease that you have on there are that it's all inclusive. And so we're going to go through and make sure that we didn't find anything else. So the initial fee for that is $750. If we get through that testing, you have put together the spreadsheet, and we know that the lease standards are absolutely going to apply, and we're going to have to add footnotes and all of that, change the financial statements, and it would be an additional $750. So assuming it applies to your district and you are going to have leases that follow, the minimum is going to be $1,500. And then really the only reason it would go up from there is if you have a significant number of leases that we have to test, because unfortunately we have to look at every agreement. We have to run amortization schedules for every single one. So that can increase that, as well as if the spreadsheet isn't filled out, if you haven't been able to get to that and you need us to do that, that's going to add some additional costs. We're assuming that you are at least going to be able to go through and put that initial list together and provide those agreements for us. So in order to help us keep the cost as low as possible, we would ask if you can do your best to complete the spreadsheet as much as possible. We know you'll have questions. There may be things you just don't know exactly how to fill out, and that's totally fine. We can help you with that. But if you can complete it as much as possible, if you can also have the agreements available so that we can review those, you're probably gonna have to pull them anyway to get a lot of that information. So if you can just have those PDF copies available and get those to us, that would be great. And I think that's probably the extent of it.
Yeah.
And then there was also a question just about sending the spreadsheets in the PowerPoint. Within the group chat on the very top, there's a PDF with the slides as well as the
Excel.
Excel.
Yeah,
Thank
yeah.
you for the lease. And then again, if you decide you want to do 96 as well this year, we can get you that one as well. There's a question, if there's an annual agreement beginning July 1 and ending June 30th, do you need to capitalize? So this is going to fall under whether it's a short-term lease or not. If the period is truly just for that 12 months, there's no ability to extend beyond that. And after the 12 months, you're done, then it would not fall under this because it will be a short-term lease. If, however, in there you have the ability to extend for another year, unfortunately, we have to include that other option. So then it will no longer be a short-term lease. So we at least have to consider it for the lease standard. If there's any other questions, if you want to put them in the chat, we'll just give it a couple more minutes. Otherwise, obviously, as you're working through this, please let us know. Kevin or myself, we can go through and answer any questions you have. And then obviously we will be going through it when we come out for planning. You know, this is something we wanted to get this out to you as soon as possible because you can start working on it now. And then if we come out for even planning, we can start to address some of those. I think someone had asked if this would be done at planning. I mean, as much as you can get done. Normally we're out there in May and June, so there's probably not too many more agreements that are going to come into play after that, but at least we can get the majority of it looked at and reviewed at that point. And then there was a question just about the spreadsheets. So again, in the chat, there is an Excel document that's called GASB 87 spreadsheet, and that is what you'll use for the lease. So if you still are unable to find it, let me know. Okay, it doesn't look like other people can see it. What I will do, I have the list of everyone that was in, has been a part or signed up for this. We will go ahead and just email it out so that you have it. And we'll also email out 96,
Right,
the
so, yeah.
spreadsheet. That way you have everything, and you should be good. Doesn't look like there's any more questions. So again, we will go ahead and end it here. Obviously, again, just let us know if you have any questions, any concerns, and we will go through this as we come out and for planning and then the audit. So thank you for your time and enjoy the rest of your day.
Thanks, everyone.